Hello, hello, everyone, and welcome to another week of Q&A with me. This week, we're going to be kind of going over just in general where we are, where the state of things are, bubbles, fizzles. We got some comments about that, and then we're going to really talk about what if any is there a recession going to happen next year. And so that's going to be the big main topic of this. And we're just going to talk about the cycles in general, basically how they kind of act, and then see if we can kind of predict a little bit of things. It's going to be a little bit tough this time. So without further ado, let's just kind of talk about where we are right now. And in general, where we are, we've been having this little asset bubble is kind of what I talk about, right? They're just these little leverage up bubbles that we have that kind of reaccelerate at the top ends of ranges. And that's where we are. We've had a small pullback recently, not really a lot. These kind of pullback can have, or these kind of leverage bubbles can have one of two things. They can have a fizzle, right? Which is kind of where they come back. Volatility typically compresses, everything kind of relaxes down a little bit, and you kind of get more of a chop, right? Or you get something like the last couple leverage bubbles that we had in 2020. So I'll get those there. There you go. Here's a little leverage up bubble right here. So we get this, and then eventually they end in a little bit of a snap, right? And they're pretty down, or they're pretty fast. They kind of pop down and they're kind of over. They chop around, and then the bull market kind of continues, kind of does its thing, right? Here's another one. Here's another example where it kind of comes over and then just snaps, right? So those are the snaps, but then of course you do get the fizzles, right? We had another one of these back in 2019. This was a mild one, so you're not going to really see it as well, but there's signatures of it, right? There was this leverage up bubble right here, and then it just kind of chopped its way down and really didn't do much of anything. So anyways, as always, by the way, I'm sitting here talking about things. You can type in any kind of questions and I'll answer them live to the best of my ability. If not, I'll save them until next time and then I'll answer them next week. So where's the market today? Looks like the market is coming down just about 0.5%. It's basically nothing. This is like stereotypical fizzle, right? Market starts to expand to the upside. Everything's starting to expand. Everything's starting to lift up. And then on the drop back, the volatility just kind of relaxes and compresses. And then there's just really not much there at all. And give me just 1 second here and let me make sure that I've got everything going well. Okay. I just wanted to make sure that everything was coming through all right. I had someone say that they couldn't hear me, but that's another deal. All right, so that's where we're at right now. Coming back, looking more something like going to be a fizzle where it's just going to kind of chop around. Doesn't mean that the market can't pull back. This is kind of like a fizzle top too. This didn't really leverage up too much, but we definitely, this is what I'm talking about where we kind of leveraged up a little bit. It really wasn't much. I wouldn't have considered it too much of a leverage up bubble. It was just, bullish. Anyways, you kind of have this chop and then you eventually drop down. That's still like a normal market behavior, right? We definitely had a lot of chops last year, right? These huge gyrations at the top. I mean, just massive days right here last year. It is not the same market as what it was last year, though. We are not in a deep pulled back, slowing growth, tightening monetary policy type of situation. We've had accelerating growth over the last few quarters. We've had yes, tightening monetary policy, but they're slowing down on their monetary policy. So we can actually see that here. I'll pull that up. So you can see that back here. And let me just turn off some of these. So here we go. We've got inflation back here in orange, and we've got the Federal Reserve interest rates in teal. And you can see this is basically the effective federal funds rate. They were really starting to crank it up right here in the beginning of the year, and preparations for that, the market started to roll over. We talked about that many times. Inflation was still, accelerating to the upside. That is a really, really strong situation for an inflationary recession, basically one where the Fed creates the problem. And then all of a sudden, the market kind of starts to bottom out here when inflation starts to roll over, and the Federal Reserve actually starts to slow down the pace at which they're hiking rates. It doesn't mean that they're not hiking, but they slow down their pace. And then they've basically come to a halt. So if we were going to try to project this out, right, if we were going to imagine if there's going to be a recession next year, how would it play out, things like that. Basically, we'd go to look at what the Fed's going to do. The Fed looks like they're going to pause, hike one more time is what is pricing into the market. And then the market is pricing in that they will start to drop interest rates, right? And then they're going to get down to, roughly, let's call it, 3.5 or so, right? Let's see if they make it down that far. They might even drop down further. And then we'll look like we're going to actually pause there for a little while and hold steady. So that's not a lot of interest rate cuts. That's at least what the market is projecting. If we were going to draw out, let's do another one with with inflation. Inflation should, and this is just, my projections and models and things like that, so it's not going to be perfect, but this should start to bottom out and actually start to rise back up. In fact, there's, imagine it's kind of like a cloud, right? So there's one potential for that to kind of happen. There's another potential that this is actually the bottom and we'll actually get a little bit of a rise, and then we'll kind of stay up here, and then we'll start to drop down pretty aggressively. So this kind of cloud, if you can imagine, there's like a few different, situations of how it can happen. And those would be different types of, scenarios that would play out like that. Now, if we were to imagine what would be the most likely scenario based on what the market is pricing in for interest rates, this one where we start to kind of rise, or we stall out and maybe rise. So something where it starts to peak up and then it kind of stalls out, and then eventually a pretty large drop in inflation back near the target, and then maybe even below it would be something like what the market is pricing in, basically. So that would mean that we end up having like a little bit of inflation, right, and a little bit of re-acceleration of inflation, and that would give the Fed, more ammo to raise inflation or raise their interest rates one more time or so, and then all of a sudden it looks like inflation is just going to roll over because the growth slowdown is going to happen. So then if we start talking about the growth slowdown, right, the growth slowdown would look like this. If the S&P kind of reacts accordingly, the S&P typically likes a Federal Reserve easing, right? So if we just go on Federal Reserve, it would look like, okay, the stock market would kind of come up here, and then all of a sudden it would just ease, right? And boom, that would be like your bull market situation, your type of scenario. But what if growth really slows down pretty dramatically, and that's what's actually causing inflation to roll over? That would mean that we'd have more of a stagflation recession type of thing. So in this situation wouldn't actually transpire. What you'd end up having is more of a rollover as this inflation starts to re-hike, right? And then a chop, and then as the real slowing growth kicks in, right, and the Federal Reserve starts to drop interest rates, we actually have a really pretty difficult contraction in the end of this year and then in the beginning of next year that would probably bottom out somewhere around, let's call it April or May or so, like that. And then eventually it would stabilize, and then we'd rise back up, and then we'd start to do things. So that's kind of that's probably the most likely scenario, is the one that I just drew up right there, based on kind of how all the macros are playing. It doesn't mean that it's going to play out exactly that way, but it's just kind of a general projection of where the recession will be, if there will be a recession type of thing. Something that it depends on how inflation kind of goes, because if inflation pulls back a little bit quicker, it'll actually be meaningful to the markets, and we could actually get some more pushes higher, right? So that would mean that we'd kind of start up a little bit more before the rollover, right? So that would mean this little bull run would actually last a little bit longer. So both of those situations would kind of show up, but likely the dip next year won't be too dramatic. Of course, that's with the data that we've got right now. If the slowdown ends up becoming more dramatic, or things kind of open up more, there is a potential to get back down to maybe the pre-COVID levels, right there, somewhere around there. That would be like probably one of the worst case scenarios for the S&P 500. Small caps would roll over a little bit more than that, because if the commercial bank or the commercial real estate starts to really, metastasize, that would end up creating a large pullback in regional banks. And regional banks are really exposed to commercial banks or commercial real estate. And the small cap, like the Russell 2000, or that one, this guy, the Russell over here, he's a little bit more sensitive to commercial banks. That's probably what's been holding him, commercial real estate, which has been holding him back a little bit. Alrighty then. So that kind of just lays out the general picture of what we're going to have next year. We have had a really, really solid little bull run right here. It's been nice. It's been pleasant as far as getting a reprieve from what was happening last year. Last year it was pretty crazy. Another thing to note is that like the sentiment right now is crazy, crazy high. If you look at the general like survey sentiment, which here's one that is publicly available. You can just go check at I'll pull it up really quick. So here is a little bit of sentiment right here, and you can see this is crazy, right? 1 year bullish high is literally what we're printing right now. Bull markets or bears have basically left the building. It is very, very, very bullish right now, extremely bullish right now. So if you're kind of the contrarian guy, I'd probably say that the market's pretty peaked out right now. But we'll see how things end up playing out. There is definitely a contraction. It's really just going to be kind of the finishing of the recession, but it is going to act differently than like 2008. It's going to act differently than .com. It's going to act significantly closer to the recessions of historical time periods in the, let me get all the way back here, into the early 70s is most likely what's going to kind of happen. So maybe late 70s too. So anyways, you can see here, these are pretty big, deep ones, but we're just going to, talk about it like here. So, here you had inflation rising, you had the Federal Reserve raising, right? The thing is that the Federal Reserve started to crack and drop interest rates in the middle of this recession, right? And it still didn't stop the market from falling, right? And inflation finally started to roll over because of the recession. Luckily, this time around, there were some, transitory variables in there, and so the recession kind of rolled over a little bit earlier. So we could get something like what happened in the late 70s, where we basically already had our contraction. We kind of rallied a little bit, and the interest or the inflation has kind of came down, and things have stabilized. But then the reemergence of inflation creates another contraction on the backside. So that's probably what's likely going to happen, is that we'll get this this deflationary pressure that we kind of drew out right here. But then unlike this actually playing out this way, you end up getting this first situation that I drew down here where inflation does keep coming down, but then all of a sudden you end up getting this kind of resurgence, and it'll kind of hang up here, and then the Federal Reserve has to raise interest rates again, which would mean that the market's not pricing that in appropriately. I'll turn that back to like the normal color. So that's kind of where we're at right now. And then let's talk about the NASDAQ bubble. So this is the question that is like, hey, is the bubble over? I know we talked briefly about this earlier. Let me delete that thing. There we go. So we talked about this briefly just a little while ago. Let me turn these guys off. But is the NASDAQ bubble over? Where is it at, right? If we look at the NASDAQ, this is of course a line chart, but if we pull up some candle charts and we were to kind of look at where the leverage bubble is at right now. So here's one, then we'll do another, and then we'll do another, so we're building our fan, right? We are basically right there. So there's our leverage up bubble in the NASDAQ. So actually the NASDAQ has not cracked yet. So there is a potential for a snap in the NASDAQ, which could actually end up pulling the S&P down pretty hard as well. So we'd end up getting the snap, even though the S&P looks like it basically was going to fizzle out because we basically already took care of the snap over here. So if we look at this and we draw this guy out, he didn't, the S&P didn't go in as much of a bubble. And then we've got one more here. And then basically that goes us to today, where we basically kind of broke through that leverage. And that would mean that we're pretty much done in the S&P, but yet the NASDAQ hasn't built that way yet. So that was the crack today. If I zoom in here, so you can see that we snapped down underneath it. Typically when you get that snap, it's a really aggressive snap. And we just didn't get that, right? Volatility's been actually contracting. It's not the same buildup and anticipation, right, of what we normally get. Typically when we get these bubbles, we'll get this VIX kind of slightly like elevating and building up, like something's going to happen on the backside here, because there's general market participation thinks that there's something building. So if we look at like the bubbles in the 2020 bubbles that I pointed out earlier, you've got this snap, right? And you've got this snap. And you can see the days leading up to the snap, the actual crack day that actually like broke through, you can see the volatility was basically creeping up, right? And then all the way volatility creeping up, and then snap, right? Volatility creeping up, snap, right? So that's the typical way that it builds. We looked like we were going to maybe get some of that with this kind of, as we got this volatility spike as the market was kind of pushing up, and we were kind of stabilizing sideways. But over the last couple of days, that volatility left the building, and that basically tells us that we're going to have a fizzle. So not a lot of energy to the downside as far as a big, fast drop. It's more of going to be like a stable, slow, choppy kind of drop unless something changes. So is the bubble over? Like that, it looks like it's pretty much fizzled, but the NASDAQ is still kind of hanging in there. With the volatility, I very much doubt that we're going to have a very aggressive drop though. All right, so those are the questions that got sent over to me, and we've basically been knocking that out one at a time. And let me show you guys this tab. So I just realized that I was still over on the sentiment. So I was sitting here talking about the leverage up bubble. So here is the NASDAQ building up. And this is where we're at. So we really haven't snapped here yet. You look over at the VIX, we've had a nice contraction instead of the rise that we talked about. I am just going over this again because I realized that I wasn't showing the screen. So here we have this rise up before the snaps in the 2020s, right? We had a couple leverage up bubbles that ended up snapping in 2020. And that's kind of more of the signature. You normally get this big kind of eking up rising of volatility at least a few days prior to the snap. And so leading up to where we're testing that, those leverage up positions, like if you look at the NASDAQ, leading up to this, we should have seen a continued rise in volatility, and we just aren't. We're getting a contraction. So it either means that we're going to continue to rise, but yet not at the leverage level. We'll end up kind of moving, more of like the, kind of a choppy up or something like that. And then we'll see what happens after that. So that's one situation. Or we could go into a whole nother situation, say something like, where it kind of contracts a little bit and then kind of goes from there, right? So we could get some sort of a reaction right now, just as everything kind of cools off from being really, really overheated. Alrighty then. Well, that wraps up all the questions that I got sent in, and I haven't seen any come through as of late. I know that I changed my time this week just because of some other meetings that I've got to take care of. Anyways, I'll talk to you guys later. I'll see you next week.